CommitToWealth.com, creating a legacy by committing to real estate wealth.
Commit to Wealth Nation, welcome to the Commit to Wealth Podcast. I'm your host, Juan Vargas. On today's show, we have Jason Yarusi. So Jason is an active real estate syndicator and founder of Yarusi Holdings, a multifamily investment firm with over 425 units valued at over $35 million. He's the founder and host of the REI Foundation Podcast, an official member of the Forbes New York Business Council. So without further ado, Jason Yarusi, welcome to the show.
Thanks for having me. How you doing?
Man, I'm doing great, man. It's a pleasure to have you on. For everybody listening, I was just on Jason's show. I want to say just, a couple of weeks ago, actually, 2-3 weeks ago.
That's right.
So it was a real pleasure to have, or to be on his show, and just go through that process. And, it was a lot of fun. So, so here we are, once again, a couple of weeks later, now you're on my show. So, it's a real pleasure to have you on my show now. So,
that's right.
So, let's start off, with, who is Jason Yarusi? I always like to kind of start off, with your background and who you are. And I thought that, my audience can find out a little bit more about you.
Sure. We're getting deep with the first question there. I love it. Well,
yeah.
So I want to commend you. You came on my show, and I spoke to a lot of people. We spoke at our meetup after. I was just talking about how you really just endured to get that first property. You just knew you wanted. You went through so many no's to get the yes, and that's just huge, right? So just want to commend you because it was just a great story. Really appreciate you coming on our show, and thank you for having me on yours. And so I live in New Jersey. I live with my beautiful wife Peely, our 3 young kids, 5, 3, and 1, our 2 bulldogs. We put a very big emphasis on family, on fitness, and of course financial, and we do that through multifamily syndication. So right now we currently have properties spread across Kentucky and Texas. We're focused on the value add component, BC assets, 75 to 150 units, looking really to provide investments for others, so we can really help them find what is their goals in life, what is their goals, whether it's cash flow, whether it's more time for their kids, maybe it's tax advantages, all of those different components. Peely and ourselves, we're very big into fitness. We're doing something right now. We're about 50 days into something called 75 Hard, where we're have committed to of course, doing 2 workouts a day, both 45 minutes, drinking a gallon of water, reading 10 pages of an actual book, no drinking, eating clean. And it's been quite an experience implementing that, but we've been doing that just to improve ourselves and just show intent and just continually to show our kids what we're going to commit to and just how we can provide a better life for them.
I love it, man. That I'm pretty similar too as well. Maybe not as hardcore as you are, like in the fitness side, but I do try to be active and I like to work out with my wife. And that if you're working together and you're doing things together, then that really does help out with not only the marriage but the family aspect to it. And I think health is a big part of it, right? So if you don't have a healthy body, then nothing else matters, right? You talk about you want to do things for your family, you want to do things for your future. But if you're not taking care of what you have right here in front of you, right there, your body, then nothing else is going to matter. So
that's
it's
exactly
very,
right.
very important. Yeah, it's so important, man. So, tell us really quick, what is that 75 hard? Is that 75 days that you're doing it? I know you said that you're doing it twice a day, 45 minutes each, but correct. Is it 75 days?
75 days. So throughout, if you mess up on any day, you start over. So there's no in between.
Wow.
There's no cheat meals. There's no missing anything. And it actually rolls into another 30 days after that, where they add on a couple different components. It was through this podcast, MFCEO podcast. Andy Frisella, he's very big into, he's got a supplement business and a number of lines of business, but a very good inspirational figure out there. And just gives a lot of real to the T points about life that we agree with them. So we like the program, and it was just another way for us to show intent, because ultimately you're right? So if we're all building our wealth and building our legacy here today, and we don't want to be dead tomorrow and have our legacy start then, right? So we want to be able to provide the best life and really expend. I have 3 young kids. I want to be out active with them 30 years from now. I don't want to have this point where, and I'm setting that up. And regardless of my level of fitness versus other people's level of fitness, it's all about being active. And everybody it's just getting out there. And if you can just walk, get out there and just do a walk. If that's the first thing. If you can only walk a quarter of just even a block, well, that's better than doing nothing. And what I find with fitness is so many people quit just because, day one, they go too hard and then the next day they're hurting, or they don't think they're seeing results because they're focused on a number on the scale, but not actually paying attention. Well, did you actually feel better? And it's the same thing with eating well. It's those, you don't just put the seed in the ground and then tomorrow come back and say, oh, there's a tree. It's really going, okay, I want to put these steps into place and I have to allow it to fester and just grow. And that's the same thing we've always done with fitness. I'm a big runner. I run a lot. I do a lot of races. But, when I first started running, I played sports all growing up, but I never ran distances. When I first ran my marathon, I could barely run a mile. It was probably like 10 years ago. I hadn't done it in so long and just done all strength training. And it's grown where I've done a number of marathons. I've done a couple ultras. I'm going to do my first 100-mile race in I don't know, 2 months or something. And it's just one of those ones where I just built it up, and it's just something I enjoy and gotten active with. But it wasn't something that I just turned it on and said, okay, I'll do this tomorrow. It was part of my lifestyle and part of my growth.
I love it, man. I really do, and has a lot of similarities with multifamily, right? Or just business in general, right? So I always talk about multifamily because that's the first thing that comes into mind, for me, because that's what I focus on. But it has a lot of similarities to just getting into business or real estate, right? Because you want to get to a certain level. It's not going to happen tomorrow, right? And it's the same thing that you said with fitness and running, a mile or whatever, right? You want to get to a certain level in multifamily investing. It's not going to happen all of it tomorrow. It's going to be step by step training. Just knowledge, education. You'll get there, right? So I really like that, man. I really like that how it kind of correlates, with what we're going to talk about.
And I'll just jump on that point there is that social media is the best thing ever because we can reach people everywhere. You and I have connected across social media. We haven't been able to meet in person. We will, but we haven't, right? So, but if we look at that, it's giving us that connection, but it also sets up standards for people where they think, oh, I see this guy has got 10,000 units, and that's all they see. They don't see the work that's done. It's like the band that ultimately is like the Beatles, but it doesn't show the years on the road going from all these shows where they're barely able to, they're just paying for beer and, the 10 years put on the road getting to the stage they're at. They just see them at that success point. So ultimately, people haven't branded in their mind what that success point is. Right. And then on that 100%. Point, it comes down to it.
100%. Couldn't agree with you more on that. So, with that said, let's kind of start from your first deal, and I don't always talk about the first deal, but, I think, because we are talking about, maybe running that first mile, let's talk about that first deal, where was that first multifamily deal that you acquired? Tell us a little bit more information about it, purchase price, any information that you can share with that.
Sure. I was in Louisville, Kentucky. So it was actually almost 3 years ago now. And I have a heavy construction family business, very active in what we do. And we just knew we wanted to find something that could supplement that business. Because ultimately, just like any service business, well, if you don't go out there and serve, you don't make any money. So if we stop doing construction tomorrow, there's no more income coming in. So we were always looking for something that could be that supplement to the business, and real estate stood out to us. And looking at real estate, well, of course, you start with things that are first things you hear about. You start doing flipping and or wholesaling or other methods, and you just find out, well, basically you're just creating yourself another business that if you turn it off, it goes away. And we started to invest in some small multifamilies not smaller things, 2, 3, 4 units out of state, through a connection, learned the process. And it just occurred to me, well, if we could do this on a small scale, it's beneficial, it's cash flowing. Well, what would be the benefits of just doing this on a giant size? What would this be? Because the economies of scale play in your favor, of course, the larger you get. And it was that epiphany that I said, well, man, this could be huge. Because if we have a duplex and we're, one vacant unit, well, we're 50% occupied. Well, if I have 100 unit and I have one vacant unit, well, I'm 99% occupied. A lot more things in my favor, and just how you could hire a staff and just have so many other things that fit with the guidelines of the property in terms of even just finding, a loan. Everything worked in our favor. So I started seeing who are these people that are doing this successfully and how can this be accomplished? And we went from that 3-unit or 3-4 units that we had that we were buying to a 94 unit was the first acquisition we did. Awesome. So yeah, they wanted $3.2 million. It was actually off market. It was a broker had it. They wanted 3.2 million. We actually offered 2.1 million, and they countered at a very attractive 3.2 million. So they didn't counter back at it. They didn't give us any counter. And we said, well, thanks guys. And we actually just said, we appreciate that. But right now it's not going to work. So we went away, and what we've done throughout, we've been diligent on tracking the properties we were offering on. And we saw a couple months later, we just reached out again and said, hey, did anything happen with that property? He said, no, it's still out there. And we went back in and basically raised our $2.1 million offer, only $50,000. So granted, we're still over $1 million apart. And all of a sudden their price went from 3.2 million to 2.6 million. And we knew that was a start there. And the overarching story was that the father had passed away, who was in his 90s. He had 1,000 single family homes and this one large complex. And who still owned this was 4 or 5 kids that were, we'll call them kids, but they were all in their 50s and 60s. And none of them lived in the state, nor were they aligned with the business. And to them, the single family homes were safer because they could resonate with that more than this multifamily property. And so we had this property that seemed to be this Achilles heel to them. And we got in there and their price came down to 2.6 because they became more realistic. And we found out later what happened was the story is they got the $3.2 million price because someone had given them a price, ultimately had done an inspection and retraded significantly on them. But they had that price set in their minds. And so they needed that time. And that's a big thing is that, the price that people ask, well, that price doesn't ever matter. So you just have to find out, what is the real surface of it? They had heard that price, so they figured that was the price. But then when they couldn't get that price, they started to get more realistic. But a lot of investors had forgotten about the property because ultimately the front price was 3.2 million. So investors would say, oh, it's just too much and just let it go away. So track your properties because people's stories and motivations change over time. So throughout, another 2 months back and forth, we were able to get the purchase price from 3.2 million. We actually got it under contract and brought it at 2.3 million. So almost $900,000 off from where we started. And it got to the end. We just said to them, we use syndication. We actually just showed them their underwriting. We sent it over to them and just said, guys, listen, we're not trying to beat you up. But we have investors that we have to answer to for this property. And these are the metrics we need to meet for the investors to make this an opportunity we can go forward as. And that was the thing at the end. It sealed the deal. And we got under contract and really were able to take on the property. And day one, a lot of this, really, the performance of the property hinged not on the building. The buildings were 1970s. The dad who had owned them had taken very good care of the building. So we didn't have a ton of distress on the building side. It was the operation side that was in chaos and in flux. So a lot of the preparation here was for us to go in there and improve the property. When we did our inspection, the leasing lady, there was so many different variables. We went in there, I think, I always forget her name, it was like Dorothy, but Dorothy was watching Dog the Bounty Hunter and did not want anything to do with us that day. She had six units, of which 5 of them were rent ready. But the phone was ringing while she was in there, not taking the phone, just a million different reasons where people wanted those units. It's high traffic. We still get almost 60% of our leasing is just from walkthroughs on the property. But she wasn't getting units walked because she wasn't putting in any effort at all. And then past that, they were having a difficult part with collections. She was not allowed to take checks in the office. They actually, the tenants actually either had to mail them or go about 4 miles away to take it to the office to pay. So she's down here in an office. The office basically served no purpose because she was watching Dog the Bounty Hunter and nothing was being done. We had found out that they were running their maintenance office for all the single family homes out of there. So their maintenance looked astronomical compared to what it really could be. They were having about 3 or 4 maintenance guys going out there where you could really service the property with one across the property. A lot of the inefficiencies were also able to prove they were under market on rents, easily $100 from similar assets. You could walk across the street, get someone who actually picks up the phone and pay $100 more in a building that was slightly less desirable than ours. So easily we had that delta and the loss to lease right there. They also weren't accepting pets. You had 600 units in the area. None of them, every other unit was $300 non-refundable pet fee, $25 a month per pet. Well, they didn't want pets at all. Well, we did our inspection, and there was 6 apartments with dogs and 1 with a snake. So it was like,
oh my God.
So they had a million different ways that they were just losing on income going throughout there. So we were able to, of course, put that back online and match that. Then we did a lot of other utility efficiencies because, C-class, lots of times your money is wasted on utilities, and whatever you can do to implement processes to streamline this, that's where you can get a lot of money back. So changed out 2 boilers. They were probably like 40% efficiency, the ones that were there. So put them back online. So 80%, 82% efficiency boilers. We also went in there, changed out some of the windows because people, as you can imagine, sometimes use the windows as their thermostat. So we worked on windows there to get that back in line, changed out toilets, aerators. We actually cut down our water bill significantly, almost 30%. So combo of changing out everything to low flush toilets, aerators, also active leaks. When you have a non-performing company who's managing a property, well, tenants don't figure they should call down because they're probably not going to get it fixed either. So one, we put things where we're using less water, and we also correct the leaks, cut down our water bill by 30%. On paper, at the cap rate we brought it at, which was we brought it at over an 8, I think an 8.5, and the property valued out appraisal at 7.5. That we actually increased the value of the property just by changing toilets about $300,000.
And that's one of the things that I always find it's just mind-boggling why current owners wouldn't just implement that, right? So a lot of properties that we see, maybe it's not in their CapEx budget, so I kind of get that a little bit, right? But just the amount of savings that you're going to get just throughout the year on the expenses, but not only that, the value that you're shooting up on the property because of the reduction in the expenses. It's just mind-boggling. Whenever I come across properties, I'm touring them, and it's like, man, everything's original, like all original toilets, all original, shower heads, and no aerators, nothing like that. Like you said, the boilers. I mean, that's another inefficiency if they're not properly working or whatever. But then you have on the other side is the electric. This is just water, but then you have the electric side of things where you can really change things around just by installing LED lighting on the exterior, right? Or in the common or the hallways or whatever, right? So a lot of that is something that you can change. You could easily. And it doesn't cost that much, right? And you can easily change the value and your reduction in your expenses, man. It's just crazy to think about that, right? But I really like your story because this is a bread and butter type of property that anybody would love to have because you found the operational inefficiencies. You talked about the leasing manager or agent that was on the property that you still remember her name because she stood out that much that she wasn't doing her job, but that just you cannot have that on your properties. It's got to have somebody that's doing their job and not just sitting around. But then you're able to check also the comps, and it was way below the market rents. On that note, how do you actually check? I mean, do you just go to a resource like a CoStar or something like that, like Yardi Matrix, or do you actually go and walk on these other properties and you ask for a tour of the property, or what is your process to be able to find out what the comps are?
Yeah, so I'll give you 2 things. One, doing all those improvements. So if we think about it from the tenant side too, right? Because what does the tenant think when someone buys a property? Oh, my rent's going to go up, right? That's the first thing they think is when this happens. But what if I show up to the property, I change all the landscaping, I improve, of course, signage, and then I start taking care of all the maintenance issues. I tackle the maintenance issues. At the same time, I'm cutting down all my expenses, right? So my property, I'm gaining value on my side. We're getting better cash flow just by me cutting down the expenses. And at all this point, I haven't touched our rent. And now I'm just going to the point here where I'm improving the property. And then on that point, then I've shown that we're making this a better place to live. And now at that time, then I'll start implementing some improvement to the rent. Maybe I'll do, if they're on month to month, I'll put them onto short-term leases where I'm going to give them certain rent bumps. If they're way under market, I may bring them up to a better value, but give them an opportunity to go to a better unit. But they've seen that we're making the property better. Instead of me showing up day one and just taking anybody on month to month and taking them right to market. And then ultimately I'm going to have that clash between, having a lot of drop off on occupancy compared to me trying to catch up on my rent bumps. And we find that we get a lot of tenant retention by doing it that way because tenants see that now they're going to have a better place to live, which is great for them, great for us across the board. And the way we do check our rent bumps is a number of things, right? You have a very fluent management company in the area. So they understand the properties have, in this area, they have like 5,000 units in Louisville alone. So they're very fluent with what's there. You've secret shop other apartment complexes, whether you walk them or call them, ask about, what they're offering, if there's any concessions, what their amenities are, what are some of the extra charges, who's paying utilities across the board. Go on sites, you can get a CoStar report, go on sites like a Rentometer that can give you those values is right there. And you can even stuff like Craigslist, see if there's someone has something up on Craigslist. And if you do those all across the board, you should be able to get a good understanding of what's happening with the market, because it doesn't always trend, right? If you have an 800 square foot 2-bedroom unit and 1,000 square foot 2-bedroom unit, it doesn't align that you're going to get price per pound, price per square foot for pennies of what you could do on that delta, right? It's not like, oh, someone's paying $800 for a 2-bedroom that they're going to ultimately pay for 200 square feet. They're going to pay $1,000 for the 1,000 square foot unit. It doesn't align like that. So you want to understand what's actually happening on comparable units out there, so you can understand where the value is that you can either bring yours to, or where you can find those other discrepancies and just decrease that delta.
That's a very good point. Yeah, I always like to go to the property, and I don't ever act as a potential tenant. I go in there and just say, "Hey, I'm interested in acquiring a property right next door or right down the road." Mm-hmm. Sometimes they'll ask me which property it is, and I'll tell them, and they're like, "Okay, I didn't know that was going to be for sale." And you just tell them, yeah. And then I'm like, "Hey, are you okay with maybe sharing your rent? I'm doing a market survey, right? A rent survey. Mm-hmm. So are you okay with sharing, what your units look like, and we can tour the property or whatever?" And sure, most of the time I've had one person out of so many tell me that that's not their process, that they don't really allow that. But for the most part, you'll actually find it very helpful. And then you can talk. You can actually ask the questions. They'll see you differently, not as a potential tenant, and tell you, "Hey, man, we charge $35 application fee. What are you looking for? A 2-bedroom or 1-bedroom, or what is it that you're looking for?" Because I want to get through all that nonsense and get straight to the nuts and the bolts. So I really like that process. Yeah. But I'm gonna go back to the other point that you made of taking care of the property before you start to think about rent bumps. I think obviously that's very, very important. And I'm gonna give an example of the current property, or the latest property that we acquired just last month. So this property was way behind on work orders. It was way behind on deferred maintenance, all that good stuff. And we had accounted for it in our CapEx for sufficient payroll, right? But then our manager actually reached out to us and say, "Hey, we're actually there's a lot of cleaning that needs to be done on the air handlers for every single unit. Is it possible that we hire somebody part-time to do that, and just a temporary person, so like that our maintenance guy that we have, he can focus on the work orders that are way behind?" And I was like, "You know what? That's a great idea. Let's actually do that. It's temporary. It's you're going to take a little bit of a hit, but you're going to take care of the property. You're going to take care of the tenants, and things are going to be turning much better, right? Much quicker, right? So those are kind of things that people see, and this is before we're starting to actually put those bumps on there, right? So I really like that. That was a very, very good point that you brought up, and so but that's the way you have to do things, right?
It's like the time versus money thing where I see this with leasing too. If you're taking on a property and has a number of leases expiring at the same time, and maybe it's going to be a little bit exaggerated if you just have the same team on place trying to do all those turns to get them back in the market. Well, it's better to pay that additional turn team to come on a little bit more money to accelerate that process, because what's your biggest thing right now? It's turnover and being vacant and your turnover cost, right? So if I'm sitting here vacant, waiting for a turn team to come in for 2 or 3 weeks, maybe I even have a lease on the property. Well, that's just money I'm not getting. So it makes more sense and I find that, sometimes with contractors, people are like, "Yeah, I found a guy who would do it for $200 cheaper." Okay, well, when can you start? Well, you can't start for 3 weeks. Well, that's not gonna work. What's your holding cost? Like your holding cost over those 3 weeks compared to that time of, well, okay, I'm paying a guy $200 more and he can start tomorrow. Well, is he qualified? Yes. Does he have referrals? Yes. Does he have insurance? Yes. Get him on board. Let's go. I'll pay the $200. Let's move on.
Yes.
Get it behind you. Yeah.
And those are the kind of decisions that some people they may get caught up on. They're thinking about just the price, and they're not thinking about the potential, the upside that there is, or the potential downside, right? Because you're going to be 3 weeks without getting this unit turned, and it's about you have to get it done quickly.
Yeah.
So I really like that. So, tell us about your latest acquisition. We talked about your first one. Tell us about your latest acquisition.
Sure.
And then I also want to talk about the markets that you're currently focusing on. I know that you said that you're focusing on Kentucky and Texas currently, but maybe we'll talk about those markets within those states.
Sure. So right now, the last one was actually a smaller property. It was 32 units. And the reason we did it is because it was right down the street from another property we had in Louisville. So we were actually able to just use all the capacity we had there. Plus the management company has a satellite office, which is right down the street. It came to us, it was a probate deal. And very interesting that it's all townhomes, 2 beds, 1.5 baths, walked in and the husband had passed away, and what we thought was his 5th wife was actually his 6th wife who owned the property. So it had gone through hands, and they had a couple properties that were more, retail commercial that were like Class A properties downtown, Class B property off the second loop, which is a little bit, outside the loop, not far, 10, 15 miles, but it's by our other properties. And they just didn't want to pay attention to it, so they were just letting it go. They gave us a rent roll and gave us feedback in the beginning. The property was something to capacity. We had 2 vacancies on 32 units. We did the inspection. They actually had 8. So we went back to them and said, hey guys, listen, we didn't sign up for that because right now it's going to change my loan, change a number of different things that we didn't model into this. So we were able to make a deal with them going to closing that our management company actually took over pre-close. And they paid for the turns to bring these units back online and any of the deferred maintenance that came with that. And we actually pre-close pinned where we had they were under market on rents. We were able to take those 8 units, put them back online where the seller and had to deal with some HVAC issues, some other things. The seller put out about $35,000 to $40,000 pre-close. We got those units online at market rent. Come in there with brand new units walking in to close. So our value based on where we started with the process came in there throughout. Property cash flow day 1, we've actually turned 4 additional units, all went easily to market. And so it's been a beautiful property. We just actually had our inspection with the lender yesterday. We did institute we do have a green loan on the property. So the green loan is going to be cutting down for the green things, which of course is, changing out aerators, putting some insulation on pipings. We did change toilets, changed out light bulbs and fixtures for LED. And that's going to cut energy by 15% and water by 20%. So quite dramatic.
Wow.
And I was able to do that on items that cost us like $12,000. It was like a simple fix. And we had some lender required repairs, which were, seal coat in parking lots, some deck repairs. And so beautiful little property. We wouldn't have taken on, but we're looking at this as, although we have long-term debt, we have good reserves, we have great cash flow. We're looking at this because the delta for where we were able to purchase it is significantly under some of the surrounding comps. We're looking at this as a potential shorter hold based on dynamics that we could get a shorter flip model out of this, because now we'll start testing some bigger rent bumps by doing on some premium units as now that I'm through all of our construction. I
love it. Yeah, and this is one of the first times that I actually heard somebody actually do some of the pre-close type of I guess negotiations, right? So you had your property management company on there. You were able to get some of those AC units replaced and just get some of those units higher to market, right? So that's pretty cool how you were able to negotiate that, and that was all because that's not what you signed up for, like you said, right? So they had told you 2 units, and it was actually more than that, and so that's a pretty cool and unique strategy.
Yeah, and I never want to retrade, and that's not the purpose here. I'm never going to. Some people, and I don't think it's a great policy, they go in there and will just lock it up high and know that they're going to beat down on price. I don't want to do that. And so if someone wants me to make an offer without giving them financials, I just say no. I say, listen, there's no purpose for me to give you an offer where ultimately it's going to change once I see what's behind the curtain. I'd rather just see what you have, really see what you have, and show me your financials. And of course, if these are what you're telling me it is, and this is all true on data, I take your word for it, this will be the price. And let's go to close. But if I go in there and we find environmental issues or other things that are just outside of our control, then that's what I find is a realistic option for us to go back and talk about pricing.
Exactly. I love that, man. Okay. So tell us all about the markets that you're focusing on. I know we you talked a little bit about that, and it was Kentucky and Texas. And you did talk about Kentucky, but tell us about Texas. Which markets in Texas and why those markets?
Sure. So we actually went in and partnered on a project that was in Austin. It was more one time because we felt good with the other management team that was on board. Predominantly, we're not focusing on Texas. We are moving really to the Southeast, just for where I feel that these last couple of years have gone, and you look at just really the dynamics of all the data points, population, job growth. Not that it's not strong in Texas. Texas is amazing, but with the Georgias and the Floridas, there's so many different points that make sense to go there. And Kentucky's a great market, but the compression from where I'm seeing C assets and B assets, it's almost like I'm paying more for a C asset there because they're valuing the value add so much if I wanted to buy a property compared to what it actually is, just based on where people are determining or thinking the market has gone to. So for that, I'd rather pay a slightly more for price per pound for a better product that's potentially a newer product and a B-class asset in a Georgia and a Florida, where I feel that the future data points and the future metrics are going to be better, right? Am I going to have more population growth in the Southeast than I am in Kentucky? Most notably, yeah, I am. Am I going to have more jobs and better income levels in those areas? Most notably, yeah. Most people don't say, "Hey, I'm retiring from New York to Kentucky," So I think you don't have a lot of that income driving from our major metropolises down to that area. And if you look at the style of construction and where the price per pound is, you are paying a little bit more, but you're also having that barrier where the household incomes in the areas we're focused on is better than what we're getting into Kentucky. So there's a more durable tenant base there, where in some of the areas, if you're in a C-class area in Kentucky, you focus on areas where tenants, they are working paycheck to paycheck, which is predominant for a lot of America. And so when recession hits, people say C-class is recession-proof. Yeah, nothing's recession-proof if people are, if you're working at Walmart for 40 hours a week and you need to do that to make your rent, and Walmart comes up and says, I'm going to cut your hours to 35 because we're having a slower season or something like that. Well, that 5 hours might be the difference of you paying your rent, because you have no reserves. And that might make a big difference here. But if you're in somewhere where the household income is slightly higher, hopefully you've set yourself up positionally better that you can have that little bit of leverage right there. So when times get tough, you're not stricken to really just be stuck to that job right there.
Makes sense, man. I like that, man, because you're right. Nothing is recession-proof. B, C, they are more of a in demand. There's less. There's limited supply, right? In B and C, they're not making it anymore. So everything that's coming up is A. So it is within that workforce housing, affordable type of range. So you do have that. But that being said, nothing, like you said, is recession-proof. So Jason, it is time for our Nuggets of Wealth. These are questions that I ask every guest every week, and hopefully they are able to help out our audience. So question number one, what is a good tool, source, or platform that you use almost daily that can also help others?
Yeah, so we're on it right now. Zoom's, and if you want to do it by video or audio, but it's also great if you are looking to do syndication. You can record these calls, and it gives you a great part that you can have it played back. And if your investor wants to go over it, but it's also good if you want to have meetings that people need to trim back to later. You can have this meeting really on point that you can record all of your data to and just give it back. It's just a highly valuable tool, right? And you can put it in Google Drive, share it across, and it's a better connection when you have this online platform too, where you can actually speak face to face.
Yeah, and plus one on that one, because there's a reason why I use Zoom. And I'm not trying to sell it because they have a free version, and they have a paid version as well. But it really is that valuable. You can use it for your everyday communication. You can use it for so many things more, recordings, whatever, right? So it's very valuable. What was the best business advice you ever received?
It always comes down to just simplicity, right? Staying in your lane and focusing on being what's better first instead of expanding out. And I guess a parallel will be, someone who's successful in, maybe the car wash business says, I want to go open up a donut franchise, and the donut franchise fails. But you think just because I open up something else that's successful, what business you have being in the donut business? You're in a car wash business, So jumping across multiple platforms before you've really gone deep and perfected your business, and then setting up the right people to work for you. So one, it's staying in your lane and then sending other people up to help you be successful by delegating roles.
What was the biggest mistake you ever made, like in business?
In business, I guess the biggest mistake is always taking on too much. I think would be it. It's always taking on too much would be one, and you want to be trusting, but you always need to get things in writing, even with family and friends, right? And it's hard to do, but it's the easiest thing to do for later on, because you don't want confusion within family. You want to have everything on paper or friends. If you write it down in the beginning, it's all clear, because you don't want to go 3 or 4 years down the road or months down the road in a business partnership, and without something in writing, maybe there just wasn't, maybe the conversation in the beginning wasn't clear. And so now ultimately there's different perspectives on how things should be handled.
Trust, but get things in writing.
Correct.
I like it, man. Got it. What book are you currently reading, and which book has been the most powerful for you?
Good questions. So I'm reading Great at Work. That's been very good. Focus on do less but obsess. And that goes back to really, I think, our first question right there. The books have been most powerful. It's always evolving. It's always evolving. I just read Shoe Dog with Phil Knight. Before that, I had done David Goggins' Can't Hurt Me. That was, of course, an incredible book. But it's always evolving, because you're always growing, right? So certain books hit you at certain times. So I'll say those last two, because those were the last two on my mind. I actually just listened to another one on Audible called Story Brands, which was super helpful, just about how you need to think about yourself, because it's formatted as screenplays. He was a screenplay writer, but the format that makes a screenplay successful is the same thing that makes a brand successful, about really how your message carries over to your customers. Because customers, that's all well and good if you're the king and you're doing all this great stuff, but the customer doesn't care, because their most important part is them, because it gets down to their primal need that they want to eat, sleep, and survive, right? And so if you're coming here and talking about, hey, I'm this big syndicator, I can do all this magical stuff and I can do all this great stuff, well, they don't care, because they want to know how that's going to help them eat, sleep, and survive. So if you're expressing empathy to the customer and then also providing authority on a platform, that's how you can most hurt a person. So if you're help a person. So if it's a limited partner, it's about them first. What do they need? What is the purpose that they may want to be involved in this opportunity? Is it about cash flow? Is it about tax benefits? Is it about they just want to get away from their job and have more time with their family? They just want to get more commitment back, or they want to diversify their portfolio. What is it that they want? Because if you don't understand that, you really don't understand how you can help them. If you're just shouting from the mountaintop, I do all this apartment investing.
Very valuable. Yeah, extremely valuable. So Story Brand, definitely got to check that one out. We'll make sure to put that one in the show notes as well. But the other two books that you mentioned there before that was Shoe Dog and Can't Hurt Me. Both books that I've read, I can highly recommend as well. Good, very, very good books. What are your rules for success?
So my wife would say focus and consistency, but I think it comes down to and the wall phrase of the book I was just reading is do less but obsess, right? Do less but obsess. Get highly focused on making what you're doing a clear message to others, so people can provide, so you can provide people value, and ultimately, if you're providing people value with passion, you can't fail.
I love that, man. Where do you see your business in the next 5 years?
We're going to continue to grow. We want to spend 3 months in Hawaii. That's where my wife's from. And
nice.
So we try and go 2 times a year. Generally, it's 10 days because we have a bunch of little kids, and her parents are over there. So for that point, we do want to be able to do this, and that's the glory of this business. You can do it from anywhere. So continue to evolve. I'm not going to set a unit number on there because I find that can distort practices. Buy bad just to get a number of unit counts. But if I can help 100 people meet their goals over the next 5 years as limited partners with us, I'll find that a huge success.
There you go. at the end of your life, how do you want to be remembered?
What's happening with a lot of the social platforms, it's great, right? Because you're doing this and you're also going to be able to show this to your kids. It's going to be this visual book that you're going to be able to provide them its guidance. I want my kids to know that I took the educated risk that can make our family better. And I also did what I said I was going to do and always followed through. And I found a can and a can't.
There you go. I like that, man. Thank you so much for that answer. I love it. So final question for you, Jason. Where can Commit to Wealth Nation go to contact you and find out more about you and your company, Yarusi Holdings?
Sure. I appreciate you having me on. Jason at Yarusi Holdings, YARUSI Holdings with an S.com. Yarusi Holdings is our website. Follow me on Instagram. I do a ton of working out, a ton of stuff that about running, all kinds of things in that platform. Jason Yarusi.
Sweet. Okay, I'll make sure to put those in the show notes. Jason, awesome. Man, it was a true pleasure to have you on, man. You gave us a ton of value. You gave us a ton of information. Just from being healthy to your all the value that you learned and things that you shared. With your first property, your second property. Just everything that you're doing. I really do appreciate that, and hopefully my audience found it very valuable as well. So with that said, I wish you continued success.
Thank you. Same to you. Thanks for having me on.
CommitToWealth.com, creating a legacy by committing to real estate wealth.